A seller has a house that isn't moving, and they're willing to spend some money to fix that. They can cut the price, or they can put that same money toward buying down the buyer's interest rate. Most people assume cutting the price is obviously better. It's the simpler idea, and it's the one everybody reaches for first. But those two options do very different things, and for a lot of buyers, they're not close. I'm Brad Haynes, a Washington mortgage loan originator. I get asked this constantly right now by agents with listings that have been sitting and by sellers who've already dropped the price once and watched nothing happen. I'm not going to give you numbers in this video. Every deal is different, and I'm not going to pretend otherwise. What I'll give you is how to think about it. Start with the price reduction because everybody understands it. Lower price, smaller loan, smaller payment. That's real, and it lasts the entire life of the loan. Here's the part that surprises people. The monthly effect of a modest price cut is small. You are spreading that reduction across 360 payments. A seller can give up a meaningful chunk of money, and the buyer's payment barely moves. It's a real benefit. It's just a thin one, stretched very long. Now the other option, a temporary buy down, a 2-to-1, or a 1-to-0. The seller funds a credit that subsidizes part of the buyer's payment for the first year or two. On a 2-to-1, the first year's payment is calculated as if the rate were 2% lower. The second year, 1% lower. And from the third year on, it's the full note rate. A 1-to-0 does the same thing for 1 year. Same pot of seller money, completely different shape. Instead of a thin benefit spread over 30 years, it's a large benefit concentrated into the window, where a new homeowner is most stretched to move. The furniture, the first repair, nobody budgeted for. When you compare them at similar cost to the seller, the buydown delivers dramatically more relief in those first 2 years. Not a little more, dramatically. Now, the most important part of this video, and the part I almost never hear said out loud, a temporary buydown does not help your buyer qualify. The buyer is underwritten at the full note rate, not the reduced first-year payment, the real one. The buydown improves their cash flow after closing. It does nothing for their debt-to-income ratio. A price reduction is different. A lower price means a smaller loan, which means a lower qualifying payment. That actually moves the ratio. So if a buyer is comfortably qualified, the buydown is usually the better use of the seller's money. But if that buyer is tight, if the ratio is the thing standing between them and an approval, then the buydown doesn't solve their problem, and the price cut might. That's not a preference. That's the difference between a deal that closes and one that doesn't. 3 other factors worth knowing. 1, the appraisal. A lower contract price is easier to support. If a buyer offers full price and asks for a large credit, the house still has to appraise at that higher number. That's a risk that lands on everybody. 2, comps. Sellers care about this more than buyers do. A price reduction becomes the recorded sale price and shows up in the neighborhood's comparables. A seller credit generally doesn't move the headline number the same way. For a seller with neighbors about to list, that matters. 3, what happens if rates drop? If the buyer refinances before the buydown funds are used up, the unused portion typically gets credited at payoff. The money isn't just gone. That's a real point in the buydown's favor that people miss. What I'd want to know if I were on the other side of this, it's seller funded. I can't hand out a buydown. It's a negotiation, and it has to be written into the purchase agreement and a separate buydown agreement. It counts as an interested party contribution, so it lives inside the same limit as other seller concessions. If the seller's already covering closing costs, that pot is shared. There are program requirements, credit score minimums, fixed rate terms, and it's for purchases. The details depend on the loan program and the lender, and it's temporary. Year 3 arrives. If a buyer needs the reduced payment to make the house work long term, this is the wrong tool, and honestly, that buyer may be looking at too much house. So the short version, if the buyer qualifies comfortably, the buydown usually does more with the same seller money. If they're tight on the ratio, the price cut is the one that helps them qualify. If you're an agent with a listing that's been sitting or a seller weighing another price drop, send me the scenario. I'll run both and you'll have an actual comparison to take to your seller instead of a guess. No cost, no obligation.